Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his
Here's the Sandman.
over Sandman.
So you're concerned about how you're going to be able to stay in your home if you start to run out of money and things get more expensive. You've got all that equity in the ground, but how do you get it out and stay in your house? Well, reverse mortgages are controversial. They're also something that could help you. And so I thought I'd get somebody in the studio today to talk about reverse mortgages. Good morning. Welcome to Protect Your Assets. I am David Hollander, your host. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. So this morning, we're going to be broadcasting and talking to our friend, Chris Freck, who is a reverse mortgage specialist. He's been doing this for over 18 years. We'll be talking about reverse mortgages more today and how they might help you stay in your home. Or if something were to happen, how would you use it? How are they charged? What are the fees? What are the taxes involved? What does it look like? It's going to be a great show, so stick around.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
So today we are going to be talking about a question that came up recently. We had a client who wanted to stay in their home. They were a certain age, had a certain amount of money, and wanted to know if they could get to the equity in their real estate without having to sell the house or move out of the house. If they lived an amount of years, they just couldn't, have a crystal ball and figure that out. So they just wanted to know if this is another asset that they could use and how that might cost them and what that might look like. And so my guest today is Chris Freck. Chris, thanks for being here today. It's really good to see you. I'm glad you could come down.
Yep, you're welcome.
Tell us a little bit about yourself.
I'm Chris Freck with East Star Mortgage and East Star Reverse, and based out of Alameda, California. I've been doing reverse mortgages since 2007, helped dozens and dozens of folks over the years. And we start with a education section where we do discovery and find what the goals are of the family and include the loved ones in the decision-making process all the way up to and including the required mortgage counseling that's required nationwide. And we love to educate and help folks come to the right conclusion, even if that is to have the family help solve the challenges that the seniors are having and staying in their home, if that's the goal.
How long have you been doing reverse mortgages?
I started in reverse mortgage in 2008 here on Clay Street in Oakland.
Was that at a bank or where were you?
I spent about 8 months at Countrywide before Bank of America bought them out. I didn't want to be there, and I definitely didn't want to stay with a big bank. I'm an independent guy.
Just thinking back to then, how has the reverse mortgage market changed from 2008-9 to now?
So the reverse mortgages started first one was in the 60s for a widow in the Northeast, and then Reagan passed it into law on February 5th at 1988.
Okay.
And so since then, there were a lot of unintended consequences, and you hear about grandma lost her house or whatever. The consumer protections that have been put in the last 10 years have changed it entirely.
And is it a federally regulated market or is it state specific?
Yeah, there's both. Just like you see state-specific regulations for real estate and mortgage in California, there's other states that will regulate it differently. Like Massachusetts was still requiring in-person counseling like 6 months ago.
Interesting.
So
okay.
it's all over the place.
All right. Well, why don't we back up? So let's start out with what is a reverse mortgage?
So reverse mortgage is a way to access equity in someone's home without having to make a payment, but they're allowed to make a payment. And it's all based on their age and the appraised value or the maximum amount that FHA allows in a county anywhere in the U.S.
And how much is that amount now?
It's $1,249,500, I believe.
That's how much you could actually borrow?
That's the where the math starts, and then the age factor. It's called a principal limit factor. That based on your age, you have to be at least 62 for the FHA product. And then based on your age, they do the math on either the lower of the appraised value or that county limit.
Okay, and would 62 be the youngest person that could get a reverse mortgage?
So if you're married to someone younger, the math will be done on the younger person's age. But if you're married, you can get a reverse mortgage with a 19-year-old wife or husband.
Is that right? Yeah. Okay, that's interesting.
Don't see it happen often, but
yeah, it happens.
It's in the book.
It is in the book. I've read some cases. So tell me about the younger. Does it help to have a younger spouse in terms of the income that you could receive off of this?
The math works in reverse. So it's based on life expectancy, and men and women have slightly different life expectancies, but they go off the younger borrower, and it reduces you have access to, because if they choose not to make a payment, then the mortgage insurance fund for FHA products has to be available some unknown time in the future. The amortization table runs out to year 99 or 100 years old, but people live longer than that. So the insurance fund has to protect itself, and that's what they've done, is reduce what they give now so that both the consumer and the fund don't end up having a claim in the end.
Okay. So we got your home's value. That's important, right? To have equity in the home to be able to do something like this. Your age, we've said you must be at least age 62.
Yep.
And you also have to have a fair amount of equity in your home, I would imagine. How is that determined? How do you distinguish that, whether someone could do that or not?
There's principal limit factor tables that are out there. Again, it's based on the life expectancy. So what I tell people is typically if you're in your 60s, you can expect to get access to about 30% of the total value.
Okay.
And if you're in your 70s or 80s, then the math goes up. Because they've cut those principal limit factors to protect the fund. Yeah. It used to be you could go to 60, 65%. Now it's kind of in the 80s is probably close to 50%. I did a loan for a lady who's 97, and it was close to 60. Okay.
So what about, I'm going to use some sample people that we'll talk about today.
Sure.
I'm going to talk about a fellow named Peter and his wife, Helen.
Okay.
Peter and Helen. Peter is 72 and Helen's 60.
You said they're married, or are they just
they are not
significant
married.
others?
They are not married. They are living together. They're not married, and they have a home worth about 1.3.
Okay, and how much do they owe?
Great question. Okay, they have a first mortgage that's fixed at 2.8%, 30-year fixed.
Outstanding.
With $540,000 they owe.
Okay.
They've got a second mortgage at a 9% rate that they owe about $170,000 on.
Okay. So I have a software that will help me model what their options are. I would tell you that they're probably age 72 is who's on the loan. Are they both on the loan, or it's just him?
I believe it's just Peter.
Okay. And that makes sense. So are they both entitled, or just the...
It's just Peter at this point.
Okay. All right. So then the good thing is he would get access to more. The age of 72, with the principal limit factor, we plug that in, and it's going to come back at something around 45% of the value. Okay. 1.3 is very close to the FHA limit. Above that, there's private label products that allow for $5-6 million valuations, and then they self-insure. So they self-insure by having higher interest rates on the reverse mortgage. Okay. But to stick with FHA, he's going to probably, at that age, potentially have to bring in some money. I I don't do anything on the back of the napkin. I plug the numbers in the spreadsheet and software and do it right. Yeah.
Stuff,
I'm happy to do that for you. But the answer is it's borderline.
It's close.
It's not a for sure thing. Now, does she want to? If he was to pass, then does she want to stay in the home?
We're going to come back to them.
Okay.
I want to. Let's move on just about the product and how it works and things like that. And we'll come back to them. Certainly, I want to explore that case. It's an interesting one. But for purposes of, again, back to the product, just sort of trying to lay some groundwork so people out there can understand how this works. So again, they need to have equity in their home. They need to be at least 62 years or older. They should have a value that justifies even thinking about this in the home. We're in the Bay Area. Most homes in this area have value of some kind.
Sure.
It's a pretty good.
A lot of them are attached to those low interest rates, like you were talking about.
Mm-hmm, like the good rates, yeah.
Sure. So you have to look at the whole picture, and I partner with financial planners like you to help people look at how do we extend the longevity of the assets.
Right.
And using a standby line of credit on the FHA adjustable rate product, I can go through the product if you'd like.
It's okay.
So the fixed rate product is just a one and done. Whatever cash you want, that's what you get.
All right. So before we go down that road, because I do want to talk about that. Let's talk about, you go ahead and get a reverse mortgage. We're going to talk about the types here in a second. But you get a reverse mortgage. What sort of payments do you have to make on the loan, if any? Is there any requirement to make any payment on the loan?
Only optional on the mortgage. You have to maintain the property charges, which are the property taxes.
All right. Yeah, good.
HOA.
So anything that's like a maintenance item or an HOA, property taxes, those you have to pay just like normal.
And a lot of folks at that age may have an impound account. And impound accounts, when you factor in, it's not called an impound account. It's a life expectancy set aside. Okay, so what does that mean? We're going to grab the next 20 years or whatever the life expectancy is of property taxes, do a reduction based on the interest accrues on it. So you get to set a little bit less aside. But when you pull 20 years of property taxes out of what equity you have access to, people say no thank you. Unless they've not made their property tax bill paid on time, there's a financial assessment that's done to establish whether they've got the wherewithal to handle it themselves. And if not, then they'll force a life expectancy set aside. So people that are used to an impound account go, oh, that's what I want, until they see the math of what happens to just set aside 20 years of property taxes with a little bit of an adjustment factor. And you're like, oh, well, where'd all my money go? It's all set aside. So you wouldn't have to pay your tax bill, but you don't have access to the money now.
Got it. Okay.
In the end, when you talk to a good financial planner, they're like, hey, don't do that. So unless it's required, people don't end up doing the life expectancy set aside. So they have to adjust mentally to paying those bills themselves.
Sure.
Or have somebody help them manage it.
Yeah. So I think where I've seen this product used successfully is where the person wants to stay in their home. They have income and some assets that can afford to pay things like the property taxes, the insurance, any sort of maintenance, repairs, things that come up like that. But they use this more as an income supplement to give them a little more monthly income. That's where I've seen this used quite a bit. Is that how you see it? Or
I thought that I would see that in the cases that I've run across. It's actually fairly rare that they do take a monthly payment. I just met with a client in Carmel this morning, and they're going to take a monthly payment, but he's also going to get a lump sum up front, and he's also going to leave a standby line of credit on the side as well.
Wow.
He's got a free and clear property, so he's got more options.
Sure. And probably a property worth a lot of money.
It's a nice house. But anyway, he was heating his home with his fireplace.
No.
And the only place you can get an FHA loan in the United States doing that is either South Florida, Hawaii, or if you've got a cabin in Strawberry and everybody else, all the comparable sales around you also do the same thing.
Yeah.
That's not how it is in Carmel. So
Interesting.
You have to. So we had to help him put the HVAC in, get that done, get a contractor to help him get that done before we could even proceed with an appraisal, because otherwise the appraisal comes out and says, we have an subject to, we need a heat source. And you don't want to spend the money to have the appraiser come back out to inspect to prove that it's there.
Sure.
Trip fees will tear you up.
That's interesting.
Yeah.
Now, what's this thing called mortgage insurance premium you were talking about? Mortgage insurance. And you got to pay a premium, right?
So some people say it's the cheapest insurance you could buy.
Okay.
If you think about it, if you are not going to be required to make a mortgage payment again, you can make one optionally.
Right.
You're not required to make one again.
Right.
And if you outlive the expected path and you end up with a negative equity, then there is no recourse. It's a non-recourse loan. The heirs can still buy the property for 95% of the appraised value. So no matter what's owed, the estate, the rest of the assets aren't touched. So if you think about it that way, you can grow other buckets into retirement to pay for care and all those other things. And the home equity at the very worst is just a wash. You're not in the hole.
I see.
And people mentally think, hey, I want to leave my home to my kids. My parents were raised by their parents who came up in the Great Depression. They all were wired to leave something to the kids, and they did. Our generation already has a home. So one of the first things we do with clients is have them bring a loved one in who's going to help advise them, or a financial planner, and say, let's talk through what are your goals here. Most of the time, those clients have never had the conversation with the next generation about, do you want my house?
Yeah.
Do you want my equity? Or do you want me to just live a quality life and be able to travel and come see the grandkids and not feel like I'm pinching pennies so much that I can't even, have a luxury at all?
Yeah.
So what ends up happening is they get freed up. They get blessed to make this decision, which if they were to do it on their own, they would say, no, I don't like this product. I can't do it.
Sure.
And I've got a story I'll tell you when you're ready.
Yeah. No, okay. We'll get to that.
Does that make sense?
It actually does. Yeah. Now, this is where I want to take a couple minutes here to talk about, my understanding is there's sort of two paths of reverse. One's a fixed, where you have a fixed interest rate and there's a chunk of money. And then the other one's a variable.
Yep.
Right? Mm-hmm. Is that right? Is that still correct?
Yep.
Okay. Let's talk about the fixed. How does that actually really work?
So fixed rate is just you're committed to it, and you get to keep it. But
for the life of your life, essentially,
yes,
right?
Yeah, of the youngest borrower, the last to leave, actually.
Okay, and that would
the youngest
be,
one could pass earlier. So
now let's. So just again, the lawyer in me is do you have to be married to be the last available, or can you be living together like our friends Peter and Ethan here? And,
my dad's a retired lawyer. I can tell you that unless you're married, you're
don't
not,
work.
No.
Okay. All right. So you should be married, and if it's the youngest one, like in this case, we had Helen, and she was 60. She would be the youngest life.
Yeah. Yep. So if either they're going to plan to get married, or he gives it to her and works on that estate plan, and
he could have the trust, be the beneficiary. Yeah.
Right.
Yeah. Okay.
But once she's on title,
then she can,
or her trust is on title.
Yeah.
You can take title and trust.
Okay.
Revocable, not irrevocable.
Okay. Well, with a revocable, the problem with that is if we put a revocable in his name, he were to die, it becomes irrevocable. She could be the beneficiary, but she's not the owner until he dies. So I don't think that would work, right?
Well, no, but then when the next generation or the non-spouse takes over, they have options. They can either refinance out of the reverse. They can
keep it going?
They could do another reverse, or they could sell the property.
Because you're going to need them on the note, basically, right? That second person.
When they become the heir, then they're given a letter that says, declare your intentions.
I see.
What are your wishes?
Because they got to remain in the house, right?
Are you going to pay for it? You're going to sell it? What are you going to do?
There's still the requirement of having to stay in the home.
So that was one of the unintended consequences from the 80s that really didn't get fixed until after 2010, which is probably most of the bad press about reverse mortgages. Grandma got kicked out of the house because grandpa passed away.
Okay.
And that was not good.
Or grandma went to the nursing home.
However, the last remaining was never on the loan and not on title, then they were not allowed to stay. Now, if you're married and you're not on the reverse mortgage, but you're married and you were living in there with your spouse when he took the mortgage or she took the mortgage out,
right,
then you get to stay.
Okay.
And that's a game changer.
That is, sure. Okay. Yeah. All right. Great. All right, that's a lot of good information. Thank you, Chris. Really appreciate this. So, hey, listen, if you're out there and you're wondering about reverse mortgage, does this make sense for you? Is this something that your parents might want to consider? You have questions? I know you do. You want to find out more about this? Give us a call. Absolutely complimentary. We will help you figure this out. 866-PROTECT. Call us right now. We're here. We're answering phone calls. Maybe we could even answer your question. 866-776-8328. You want to know more about this? How you can get at the equity in your ground without having to sell the home or move out of it? 866-PROTECT. Coming up next on Protect Your Assets, we're going to get more into this important subject. It's coming up next. Keep it right here.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Welcome back to Protect Your Assets. I am David Hollander, also known around here as the Sandman. All right, so just to circle back, we were talking about the reverse mortgage. It kind of breaks down into two categories. There's the fixed interest rate, where you get a chunk of money, and then there's a variable interest rate where other things happen we'll talk about. So on the fixed side, we were talking about that. So it's a fixed rate of interest. Yep. And it pays out a chunk of money, again, depending on some of the factors you talked about earlier. Is there anything else we should know about that?
It's just that it's once you get it, whether it's a FHA product or a private label product, once you get assets dispersed to you, that's the end. You can't get access again. Okay. So it's untouched equity, which is a good thing, but people underestimate how much they need in the short term. Sure. And then they mostly when you get somebody like a financial planner involved and start planning out what their expenses are going to be over a period of time, they come back and rethink. And oftentimes they end up not wanting the fix. So statistically nationwide, the fixed rate products are maybe 10% or less of the reverse mortgages that get done. And most of them are on the adjustable rate product.
So does the adjustable rate product make payments to the recipient?
So there's a bunch of options. So I call it the bells and whistles.
Okay. How many are there roughly?
Well, there's you can receive a combination of these. Okay. You can get
okay. This is where you were talking about that story earlier, where you had somebody who's getting an equity line, and getting some payments, and maybe some cash out.
Yeah,
right?
You can get all of those things.
Okay. So let's just again for time's sake, there's multiple ways you can get access to this capital on the variable side. Upfront
cash. A standby line of credit. Or either a lifetime or a tenure or term monthly distribution.
And term is a certain term. So if
you can say, I want it for 5 years, I want it for 10 years, and I want to stop.
What if you did 10 years and you died in the 8th year?
Whatever unused equity is left wasn't ever tapped, then it goes to the heirs.
Or it could pay to your spouse.
Is she on the loan or not? Yeah. Well, then the loan doesn't stop because the older one passed.
Okay. All right.
Or the younger.
Yeah, I mean, these are right. There's
still somebody in the home and they're on the reverse mortgage, then the product is still open and functioning.
Understood. Okay. That's good to understand. So on the variable side, it sounds like the variable side has a lot of flexibility.
Yes. It's where 90% or plus of the reverse mortgages in the U.S. end up.
That is
They may
super
start with fixed, but they don't, once they see what the options are, they
Interesting. And then how does that rate adjust?
So it's based on the SOFR, if you're familiar with that index.
No, what is SOFR?
It's a manufactured index that was built to replace LIBOR, which was the London interbank offered rate, which was manipulated by foreign actors.
Okay.
And so the federal government said we can't have somebody overseas manipulating interest rates for our U.S. customers. So they created SOFR, and it took them a long time, and they were late with it, like everything else. But that is now what the index
standard.
is.
Okay.
And then you've got a margin, and the client gets to choose the margin. There's a range of margins, and I'll give you 2 reasons why. And I'll give you a little quick case study.
Sure.
So I had a client that bought a condo in Oakland. She didn't need me because she had cash. She'd inherited her husband's IRA. She went all in on the cash. And again, she didn't need to talk to me because I'm a loan guy and she's got cash. She didn't factor in that she had federal and state tax liability that was coming her way. And when she got the bill, she paid cash for the condo.
Wow.
So she then said, her neighbor said, you need to go see Chris because he can help you. And I ended up getting the entire building approved for FHA so that I could get her a reverse mortgage. And I broke my own rule about including a loved one in the whole process, education, conversation, everything. Because she said, my son's, I've got one kid, he doesn't need the money. So I left him out. I broke my own rule, first and last time. And at the 11th hour, he comes in after I've done, getting a building FHA approved is not a small thing.
I bet.
And it was for one customer, my future customers, but it was for this one lady who needed help. Well, the son comes in at the 11th hour and says, hey, what are you trying to pull on my mom? Standard, I would do the same thing. And I said, well, would you like to listen to what I have been trying to propose? Or he said, I'm going to just get a HELOC at my house and I'm going to do it. I'm like, great. That's plan A should always be family solving the problem with family. We're here to educate. If you want to listen, then great. So he comes back a year later. The son comes back a year later and says, what were you telling me about this thing? I still haven't solved this problem. The IRS tax payments are accruing interest and I haven't solved it. And when I educated him on the product, he went from being a hater to being an advocate for her to take the and the highest margin possible. Why? She owed the IRS taxes. That was going to be like $50,000. She had a $250,000 standby line of credit that she was able to pull the property taxes out of every month, or every 6 months when they're due, and the standby line of credit appreciated faster than the pullout of the property taxes. So I just talked to her a little while ago. 9 years later, her line of credit is bigger than when it started, and she's pulled 9 years of property taxes out of that line of credit, which has improved her cash flow
and she paid the bill.
Yes. She took care of that, and she's got more money than she started, access to more of her equity than she started with
because
9 years ago, because we set aside that standby line of credit. Yeah. So the son went from no to get the biggest margin you can.
Sure.
She ended up going with a lower margin because she didn't want the highest margin. She didn't want it to accrue faster, but the balance is accruing on the loan and the standby line of credit at the same rate as the mortgage. So if you think about that, if you have that imbalance of 5 to 1, 50 and 250, I'm on radio using my hands, but
you're being recorded.
You're gonna outpace.
Yes.
Assuming that you just make those minimum draws. We modeled it out on a spreadsheet. The son was a software guy and he loved the spreadsheet. We modeled it out for 20 years and said, here's where she's going to be when she needs care.
Interesting.
And it won't be coming out of the son's pocket. It'll be coming out of the equity in her home that she's set aside.
Good. That's good. So what happens when she ultimately passes away? What happens to the reverse mortgage?
So there's a list of contacts that are required when you close a reverse mortgage in case they can't reach you. Really quick, they do a once a year proof of life check.
How do they do that?
They send out a letter.
Is it a letter now or an email?
It depends on the servicer.
Okay.
It's still a letter in a lot of cases.
Right.
But if you don't reply in blue ink or answer the phone, then they're going to go to your alternative contact.
Okay.
Typically, the loan guy is not. The financial planner often is. And they say, have you heard from Mildred in the last 6 months? Oh, yeah, she's in skilled nursing now. Okay. If you're out of the home for 12 months, for whatever reason, then that loan has to be dealt with. And you have time to do it. But the mistake that people make is putting their head in the sand and not ignoring or hiding, trying to hide from the servicer. I had one client whose mother passed away, and the son, who was a disabled veteran, was living in the house still. It's like, well, we could help figure this out, but you've got way too much equity. Don't get foreclosed on. They stuck their heads in the sand so much so that there was a foreclosure notice tacked to their door.
Oh, boy.
And they lost the equity.
Oh, boy.
Because they were trying to hide the fact that the mother had passed away.
That's awful.
So the thing that I tell them is don't ignore them. And whatever you get, anything you get from the servicer and anything you get from the county is about money, and they're going to probably want it. So just send us what you're looking at. Send it to your financial planner, your trusted loved one, and then let's work it out. Yeah, we can communicate. I can jump on a call with them and talk to the servicer because that's their first time talking to them. We jump in and we're allowed to be, if they authorize us to be another contact, but we have to have them give us permission.
Good. Is a reverse mortgage right for you? I know you have questions. Call us 866-PROTECT. The number to call to find out about reverse mortgages right now, 866-776-8328. Call and get some information now. Chris is here, 866-PROTECT. Give us a call right now. Coming up next on Protect Your Assets, we're going to get more into this important subject. Coming up next, keep it right here.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Welcome back to Protect Your Assets. I am David Hollander, also known around here as the Sandman. My guest today is Chris, and we were talking about Helen and Peter, their situation, and what would you like to know about them? Like, where would you go with this case?
So,
because they want to stay in the home. That's the objective.
Yeah, and that's important. Do they have kids from different marriages?
No kids.
Okay. So that's helpful. And they have joint assets or all separate?
It's all joint. So they have liquid, approximately 1.2 million liquid.
Okay. And kind of what rate of return are they getting on it?
They're getting about 5.5%.
Okay. So when you look at that case, you can go two different ways with it. You could do a reverse mortgage for him now, and then you free up the monthly payments if they qualify. Now, you can bring, it's not common, but you can bring cash in. And if you think about the blended rate between that first and the second, the blended, you could calculate that blended rate. But it's probably, if the first is at 2.8 and the second's at 9, the blended rate is probably in the 4s, maybe low 5s. So how much cash flow would you free up in that short term if he's going to have that reverse mortgage? And then if you set aside the funds, you can make payments on these reverse mortgages. You don't have to just let it run like it's designed. You can make optional payments when and if you choose.
Sure.
So they could make an interest-only payment. They could make a half interest-only payment and model it out to where they have no payment. They free up the cash flow. And then when she is of age, they can
and again, we're assuming that, are we assuming then, when you say of age, that he's
62.
Passed? Okay. Not that he's passed.
You could model both.
I see. But, you know, I've seen a practice where you think something's going to happen to one person and it happens to the other, you know, and all of a sudden.
Absolutely.
So
the caregiver is the one who breaks down first because they've been given everything they've got to take care of their spouse.
There you go.
That happens all the time.
Yep. Anything else for this case that we should explore?
I just think there's a lot of moving parts there, but the very first take is he's 72. The combined loan to value is over 50.
Yeah.
He might have to bring in a little cash to get a reverse mortgage, but it doesn't mean that that's a bad thing. You have
Right.
to look at where's the return on that investment compared to the 5.5 that you say they're earning on those assets.
Exactly. Okay, I like that. All
They
right,
could
you
be
had a
paying
case.
themselves.
You had a case you wanted to talk about.
Yeah, so I had a client whose husband passed away. They'd paid cash for everything. Their house is free and clear. She calls around trying to get a reverse mortgage, and she can't because she has no credit.
No credit.
No, they paid cash for everything.
Yeah.
For 30 years.
Literally. Okay.
So they don't. Other folks said no, but we know the guidelines. We went and helped build alternative credit. Got a couple of conference calls with the client and the utilities and phone bill, that kind of stuff, and we built her a credit score. And then we were able to do the reverse mortgage for her because she didn't have a solution. She was in her late 80s and wanted to stay in her home, and her kids wanted her to stay in the home. And
was she in a situation from a cash flow where she didn't have enough to pay her bills, or was it more of a long-term care? How did
she
this come
has a
about?
son who's special needs and is going to need care, and she didn't have a special needs trust set up. So she was literally taking care of her husband until he passed. She's 87 years old, and now she's caring for a 60-something-year-old disabled son.
And so let's explore through that. So what happens she's the owner, I assume, on the home.
Yeah, she's the remaining owner.
Yeah. So what happens when something happens to her? That house will be sold, won't it?
The alternative contact gets contacted and says,
Here's the
what are your
situation.
choices? Here are your choices. You can keep it. Could be a niece or a nephew, somebody whoever's on her next of kin, trust, successor trustee, whatever. What are the wishes of the family? A lot of people just say, oh, they want to sell. Some people say, I want to move in. I had one where the mother had a reverse mortgage and the daughter was caring for her. She passed. The reverse mortgage was due and payable. The daughter had turned 62. We did a reverse mortgage to refinance her mother's reverse mortgage so she could stay in the home that she had lived in since she was 9 years old.
Wow.
And she never had, and she didn't, the education that it took for somebody who'd never had she'd lived with her mother, cared for her mother, and never had any credit or a mortgage.
Sure.
Understanding the whole process, that was part of the approach we take in education.
Yeah.
So
which is a huge part of it.
That was an amazing story also. That's a third one, a fourth one.
Yeah.
But to have the mother's reverse mortgage get paid off by the daughter's reverse mortgage so she could live in the home that she'd lived in since she was 9 years old.
Right. Yeah. That's a big one.
That's a Cinderella story.
Yep. Well, we are out of time. I really do appreciate you being here today. Thank you for this.
It's my pleasure. I hope I can come back soon.
Well, this has certainly been a great show. A lot of really good information. Of course, there's still more. It is quite a subject. So Chris has been here, and I really appreciate you being here. Thank you for coming in. I want to, again, throw it out there. Look, if you need help with reverse mortgages, you want to get more information, you want to get connected to Chris, find out what you probably don't know, how this could or maybe not work for you, call right now. We're here, 866-PROTECT. We can help you look at this, look through it. 866-PROTECT. Again, the number, 866-776-8328. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. This was fun. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You are listening to the Protect Your Assets Radio Network.